Want help to grow your business? Download BRiN, the world's first business advisor in your pocket. To find out more, visit BRiN.ai or search the App Store today.
Welcome to Empire Builders. Now, when you're trying to build a property portfolio, it's not simply a case of just buying any property whenever you feel like it and hoping it's going to grow in value. There's a bit more sophisticated thoughts behind the scenes on that. Now, I'm certainly not that expert, but I've got one here today. His name's Louis Christopher from a company called SQM Research, one of Australia's top firms in finding out what's going to happen with the property market. Good to see you, Louis.
Good to be here, Chris.
And it's always interesting, as soon as you guys come out with your data and the rest of it and your predictions, it's the kind of thing that everyone wants to know. They're always wanting to know what's going to happen in the future.
Oh, and, everybody loves a crystal ball,
and you're the guy with a crystal ball.
Yeah, that's it. No, look, we've been fortunate over the recent years that our forecasts have come in largely. We're pretty happy about that. One thing in this game is that we think it's critical to be very transparent and open about how the forecasts have gone. Sure, you're going to get some wrong from time to time, but it's all about, well, why did you get those wrong? And you actually learn something more about the markets. Even after spending probably 15 years, 18 years now in following property markets, I'm still learning today. I think you'll always learn. And by learning and being accepting of that, you can actually make better forecasts going forward. But no, we've been happy with our forecasts. We got the Sydney property boom right. We've got a few of the other capital city markets right in Australia, and picked a couple of global ones as well.
And it's a really good point about you saying that you're learning as well, because so many people, whether investing in property or shares or business, they're trying to wait till they know everything. And they're never going to know that. So they've got to get a bit of knowledge so they're not kind of making stupid mistakes, but they've got to realise that you're never going to know everything, are you?
That's absolutely right. I think the best lessons you learn are the ones where you make the mistakes. It really does get burnt in you. And I was actually fortunate enough that I made mistakes earlier on in my life. I actually bought my first property. It was a commercial property when I was 23. And I just got through that, learned a lot of lessons, got a new hairstyle through it, but learnt a lot and took off from there. And the transactions after that and learning a lot about how the markets really operate, I got a lot out of that first experience.
Now, tell the viewers kind of a bit about your background. So where's your expertise coming from?
Yeah, sure. So it's been statistical orientated in terms of my professional career. And involved in the investment market. So my first job out of university, I was working with a fund manager called MLC, and then I moved to a group called the Securities Institute of Australia for a number of years, where I covered a number of major asset classes. During that time, my personal experience was always property bound. Then about 15 years ago, I took a role with a company called Australian Property Monitors, who's owned by Fairfax today, and that was a research role. And that's probably where we started my claim to fame, I guess. We built a number of house price indexes, which is used by Australia's central bank today and still published today. And I was really keen during that time just to really improve the level of real estate information out in the marketplace. And that was one of the things I learned earlier on, and why I was making the mistakes when I was a younger lad, was that I didn't have the right information. And I think that's critical. And really that's what my business is all about, providing really good, insightful, and importantly, objective information out there. As you know, Chris, I'm more than happy to call a down market where we see one. That's all part of what we do, being objective, and that's how our clients benefit from us, by getting really insightful and yet objective information.
And the objective is a really good word, because so many people follow the media, whether it's internet, newspapers or wherever else, and they say, oh, but this person said this. Most people have a vested interest in saying a certain thing, especially if the information's free, isn't it? So if they pay for information that is objective, then ideally that's better information.
Well, Chris, you get what you pay for in this world, don't you? There is a lot of free information out there, and sadly, people want independent information, but very few actually want to pay for it. They don't see the value, but yet there is value in it. My clients have definitely benefited from getting really insightful information in terms of timing those markets and avoiding certain markets where it was quite clear the markets were going to go for a big fall. So we were one of the first to be out there about the mining towns. We were out there about what was going on with Perth, and the Perth market is still correcting today. Yeah, look, objective and critical information is very important out there, and getting it from an objective person, very critical.
That's good. Okay, so let's get into some of the property market.
Yeah.
Tell us what you think of the inflationary environment we're in at the moment, and how does property typically kind of react in that environment?
Yeah, I think globally we are definitely in a lower inflationary environment. And for property, this is good and not so good. With a lower inflationary environment, it means lower interest rates. And that means that property actually increases in value because people are looking for yield. They're looking for rental yield. So property has actually so far benefited from this lower inflationary environment that we've had. On the flip side though, rents generally actually only rise marginally during a lower inflationary environment. We're already seeing that globally, where rental growth has slowed right down. And in such an environment, it's actually critical to try and find those markets where you're going to beat inflation on the rental side. And that does boil down to trying to find those regions which have good long-term underlying demand.
So you talk about the yields there with property. What about the growth as well? So if you've got low inflation, and does that mean then more people are attracted to it because then it's maybe more positive cash flow or less negative geared, and then suddenly property prices are rising from that?
Oh, I think property prices are rising more because of the global chase for yield. So in a lower inflationary environment, people are trying to find some type of yield. Putting the money in the bank, you just won't get anything at all in such a lower inflationary environment. Like the banks in Australia, for example, are offering term deposits at, in some instances, under 3%. Okay, so people out there are just trying to find an asset class where they're going to get some safe yield, some safe income streams, and property can definitely offer that. And so what's happened is that as interest rates have gone lower and lower and lower because of low inflation, property yields have also gone lower and lower. And to simply explain how that works, if a yield on a property when you acquire it is at 4%, and then you sell it back into the market at a later date on a 2% rental yield, you've actually doubled your money. That property's actually doubled in value.
Okay, and so is there a chance that we can actually get into deflation now?
I think so. I mean, the flip side in all this is that the central bankers of this world are struggling to deal with this lower inflationary environment. They've all been trained in terms of how to handle high inflation. That's what they've learnt in the textbooks, but very few have been taught how to handle deflation, falls in prices, and how you respond to that, because that can be just as damaging to the global economy. And so far what they've been doing is suggesting, okay, let's put out more debt out there, let's have lower interest rates to keep debt cheap. So people have been taking on more and more debt and been buying things such as property. But the issue with that is by taking on more debt, it is affecting their disposable income, and people become more conscious about how much debt they're holding, and they tend to want to pay that back as opposed to go out there and buy a car or buy some type of discretionary item. And so it becomes a self-fulfilling prophecy that more debt means less disposable expenditure in many respects, and that creates the deflationary environment. It's going to be a tricky one and a difficult one for the central bankers of this world to get the global economy out of.
And so who are the typical winners and losers out of that?
Okay, the typical winners tend to be creditors, and those have been smart to hold real assets because, as mentioned before, real assets such as property actually rise when interest rates go down. The losers are those which basically take out debt and don't spend it on the right things. And they're left with this big debt where they're finding it more and more difficult to service because their wages are not rising as quickly as what they used to.
So it's the basic economics. So you go and blow your money and you're not sensible with it, then in deflation you're going to be in more trouble.
Especially in a deflationary environment, no doubt.
And so when it comes to, like a lot of the times we talk about the property market, and we obviously realise there's lots of property markets. When it comes to, say, the top end of the market, how well is that generally done?
So the prestige property market worldwide in recent years hasn't actually done as well from what we can see in our data. And we think the reason is because investors, which have been driving the recoveries in Australia and in, for example, the UK and in the United States in many respects, have been focusing on the lower end of the market. On top of that, our long-term accommodation needs is for affordable real estate. So underlying demand is targeted towards the affordable end of the market. So in the last, I'd say, at least in the last 5 years, maybe 10 years, but certainly in the last 5 years, affordable real estate has actually outperformed prestige property. And we think that's going to continue. And it's not just the affordability factor, it's also the transaction factor as well. When you're transacting on prestige property, you tend to pay proportionally high transaction costs. So stamp duties in Australia, for example, are a lot higher. Land tax is also often involved. So in Australia, there's a threshold on land tax, especially when it comes to prestige property. So that's another reason why investors tend to stay away from prestige property, and hence why prestige property has underperformed in recent years.
Because is generally the growth just a lot more lumpy on those kind of things?
It's lumpier. It's also a smaller market. So when we talk about markets, what we like to see as property investors is deep, what I call deep markets, where there's high sales volumes, and it means that when you want to get out, you can quickly get out.
Just like with the share market, effectively.
That's exactly right. But at the prestige end of the market, and also with other markets such as, for example, mining towns, I call them shallow markets because there's not as many buyers out there. And so you can actually end up having a situation where you're holding onto that property for longer than what you actually want to.
Yep. So certainly when it comes to property, not just buying any property is the way to go. You certainly need to look at what you're getting into. Now join us after the break. We'll be delving in really deep into what kind of things you should be looking for. Join us soon. Welcome back to Empire Builders. Joining me today is Louis Christopher from SQM Research, and we're really delving into what do independent authorities on property think about which way we should be going. So just before the break, we were talking about prestige property and thinking that it's pretty lumpy. Does that mean generally prestige property isn't the best thing for most people to invest in when it comes to property?
Look, I believe so, Chris, and maybe others will disagree with me. But certainly for your average investor, I think it's about buying within your budget, for starters, and let's face it, the average investor cannot afford, say, a $2 to $3 million property or more. So buying within your budget, and also buying what underlying demand needs the most. And I think long term, our accommodation requirements are going to be for affordable real estate. That is the reality. Now, of course, as the population increases in all our major capital cities, the population of the wealthy is going to increase as well. And that's another matter. I'm not necessarily saying that you don't invest in, say, prestige areas. You do consider prestige areas, but you try and go for affordable property within those prestige areas.
To continue enjoying this presentation, download BRiN, the world's first business advisor in your pocket. To find out more, visit BRiN.ai or search the App Store today.